Investors and traders, welcome to the channel. Market chart pattern today is 5th of May 2024. I hope everyone is having a great weekend. In this video segment, we are going to take a look at the key US markets. So we'll start by taking a look at our timing model, which has done a pretty good job based on the Dow Jones cash market. Then we'll take a look at the dollar index. We'll also take a look at the EURUSD and also briefly Bitcoin. Then we'll look at the debt markets through the eyes of the bond futures. So we'll look at the US Treasury note for the 2-year duration. Then we'll move on to the longer end of the curve by taking a look at the 30-year long bond futures. And we'll also take a look at the TLT, which is of 20 plus year duration bonds ETF. A brief look at the gold market, and then we'll deep dive into the US stock indices. As always, this video is for educational purposes only and it is not a financial advice. With that, let's start by taking a look at the this chart. This is the daily chart for the Dow Jones cash index. It is not the futures, and here what you see on the screen is a timing model that we have been following for quite some time. I'm not going to go into the details of this model in this video because I've already done a video on this several months ago when we started to take a look at this model. The long-time subscribers will know. The new subscribers, welcome to the channel. If you are interested in that, I will actually try to put a link to that video towards the end of this video, or also try to put it in the description. So here briefly what we are looking at is that this model has done a good job for us by giving us an indication of key times. So for example, the 20th of December, it called for a shorter term high, and the market just went sideways to lower for quite some time. In fact, this is what we saw in the beginning of the year 2024, and then the next one came in around the 27th of February. And the way it works with the timing is we have to give it 2 to 3 trading days on either side for the timing. Time is more elusive than the price. And again, what we saw a high come in for shorter term on 23rd of February, and the market just went sideways to lower for a few days, about a week or so, and then putting in a low. And then the other one, the more important one, came in on the 2nd of April 2024. And then we had another one, which is the 4th of April. That was the low to low cycle, and we were expecting a low, but looks like there is a bigger cycle which actually pushed the prices lower, which was picked up by this Fibonacci 1.618 external extension. Now we have 2 key dates coming up later in the month of May. So that's between the 24th of May to 29th of May. So what we are expecting is for this correction to complete by then, and we'll wait and see what will happen. We can only forecast. We have no control over the market, but this is what we are expecting per this model that we have been following. So with this, we have to give it 2 to 3 trading days on either side, and it's a bit of a range, and it's a range because we come into the Friday, and then of course the 25th and 26th are holidays, and we start again on 27th, which will be a Monday. So between 24th to 29th, we'll have to give 2 to 3 trading days on either side, but that's the kind of the time zone that we are expecting. All right, so what we'll do now is we'll take a look at the US dollar. So this is the daily chart for the US dollar, and here from our perspective, as the video was done last Friday, I think that this is a pretty good top in here. Initially we were looking for probably 107 to be reached, so challenge of these highs. That might not happen, and the reason is because the price has moved below the 38.2% retracement, and also if you look at this trend line, it has actually closed slightly below that. One more close, a good close below this trend line, in my opinion, would actually make this more concrete for us. And if we begin to take a look at from the momentum perspective, and the price actually on 2 consecutive daily basis has closed below the 20-day moving average. So that 8-period moving average, if it begins to close below the 20 moving average, then that also indicates that the momentum is also turning negative for higher prices for the dollar index. And if a dollar index puts in the low, it usually is positive for risky assets. Now we have seen a double top here, another double top here, so that's another possible double top in the making. Now on the flip side, if for example the dollar actually begins to strengthen, then on the weekly chart we do have, so the first thing is that it needs to really close above the 107 levels. It needs a clean close above that to be able to target 108.75 and even higher. And dollar getting that strong will in fact change a lot of things. So what we are waiting for is further confirmation on the daily charts. This is what we are waiting for in the dollar index, but the chances are more on the weakness for the US dollar. Now let's take a look at the Euro USD because the dollar index is about 50% of the Euro currency, and here clearly on the daily chart we can see a prominent downtrend line here, and last Friday when the market rallied, it went right into it, right at the key retracement level as well, which is 50% of this move, and it might actually be the 38.2% retracement of this entire decline. There we go. So there's a pretty strong resistance here, and it has also come in the form of an ABCD formation. So here we go, there we go. So it's quite similar to what happened around here. We had an ABCD, but we had a deeper retracement into the 61.8% right here of this move. So here we have a confluence of the pattern formation ABCD. We also have the 38.2%, and we also have the 50%. So when we have a confluence of these many things, those levels tend to be strong support or resistance level. In this case, it is a pretty strong resistance level, and this is why we saw after a strong rally, market went right into this zone and pulled back quite a bit, gave up more than, or roughly about 50% of that move. Now, in my opinion, the euro and also the dollar, they seem to be actually stuck in a trading range, which is a fairly large trading range. And the reason is that on the downside here, we also have a confluence of several Fibonacci ratios and pattern coming together. So first of all, when the market came right into this on the 16th of April, that was the 78.6% retracement of these lows to these highs. Then what we also had is this black line ABCD completing right in this nearby that region, and then we also have the 1.272 expansion and 1.618 expansion. So 1.272 of this move. Let me actually try to draw it for you here, and I'm gonna make it a little bit thinner. Here we go. And the 1.618 come also nearby in that region. So we had a confluence of several things, and this is why we have seen the market actually attempting to move higher and then moving into a fair amount of resistance here. So this is why the market really needs to get above this trend line. Once it does that, I think that's going to be a further confirmation that we are likely to see a weakness in the US dollar. So again, the next trading week is a really key week for a number of markets. We'll also take a look at the Bitcoin. So here is the chart for the Bitcoin versus the US dollar. Now, one of the things that we were really watching for was this 38.2% retracement coming around $60,000 per coin. We also had this one-to-one price projection. The market actually moved a little bit lower, but it has recouped a lot of this. It's still, the momentum needs to operate a little, improve a little bit, because the price did close about 20-day moving average. But the 20-day moving average is above the 8 moving average, or the 8-period moving average is below the 20-period moving average. So this is something which the shorter term traders like to take a look at. And also we have this a little trend line here, which was actually broken. So that's a good news. So really watching for this one. And if it begins to close above the 67,000 by taking this swing high out, then maybe this pullback that we have seen to the 50% is all that we were going to see, especially with the weakness in the US dollar is likely to continue, and then Bitcoin could actually moving higher, maybe a lot higher. And now we'll just begin to take a look at the bonds. So we'll start by taking a look at the treasury treasury note market. So this is the shorter term end of the curve. This is the 2-year treasury note, and here what we can see is 3 consecutive daily closes in the negative. 5% is the level that we were really watching for, and I previously mentioned this pattern formation of 1-to-1 price projection ABCD. With this, in my opinion, there's a pretty good harmony or symmetry between. It's not the 100% exact symmetry that I would like to see for head and shoulders pattern between the left shoulder and the right shoulder, but it's nearly there. So that's why I'm considering this to be a head and shoulder pattern in the 2-year treasury note market. And what the pattern calls in terms of the ABCD is with what you see in the black line. Actually, the yields could actually move as low as the 3.9%. Now, the key thing again will be to watch this trend line in blue. If we begin to see consecutive closes on a daily basis below this, then it just indicates that this high, which came in right at the 78.6% Fibonacci retracement, also the 1-to-1 price projection, so a confluence of two things coming together is always something we pay really close attention to. Might have been a pretty strong resistance level, and the market now begin to move lower, which is going to be good in the sense that it means that the yields are actually moving lower. So actually the speech that Chairman Fed Powell made during the FOMC meeting, responding to press, he mentioned against a question that even if the data is coming in hotter than expected for inflation, the next move for the Fed was not to actually raise interest rates, and that changed quite a few things, because if there were market participants who were getting nervous that maybe because of harder than expected inflation data, the Fed might actually be looking to increase the interest rates, that would be a very different scenario. And of course, this is an election year as well, and it has its own little pattern formations. I think it deserves a video of its own. And now we are in the month of May, and the elections take place not far away now in terms of time. So I'm not suggesting that the Fed is political or anything. What I'm trying to suggest is that the markets have certain kind of rhythms during the election years, and usually the stock markets tend to rally if the first quarter has been positive, which has been positive in this year of 2024. So the chances for the markets to rally in the summer is actually higher. That's just my opinion or perspective, no financial advice. Okay, so now we'll begin to take a quick look at the 10-year treasury note. Here again, we have seen a nice rally last Friday especially, but the rally is a little short of what we would really want to see. So in this move, what we can see is that there is a symmetry here. So whenever the market begins to rally about this much, maybe a little bit higher, sellers come in. So it really needs to close above 109.16 level, and if it's able to do that, then in my opinion would have broken the period symmetry, and then we could see a 1-to-1 price projection ABC taking the market much higher. So in other words, lower yields. This is much better visible on this chart, which is the 30-year long bond futures. This is on the longer end of the yield curve, and here this is something that we had been watching for as a potential point C, and at one point it did look like maybe the point C was broken and this whole pattern actually would fall apart. But yeah, the market is for a number of days, weeks now, a week and a half, is trying to stay above this level. So if that remains the case, what we are really looking for is again a close above the 118.25. Before that, if it's able to just get above the 116, that would be really good. but the bearish symmetry will be broken at 118.25, and that would be a much positive development, that even on the longer end of the curve, the yields might be moving lower. And this move could be a multi-week, multi-month move, which could in fact see prices just getting right into here, maybe challenge the stop as well. But we could still be in a bear market in bonds, so yields eventually begin to rise again. But for now, it looks like we might have a rally which might be attempting to develop here. So we are waiting for further technical confirmation. Now we'll take a look at the TLT, which is the 20-year plus duration treasury bond ETF. And here we have a similar kind of a pattern, so a beautiful looking 1-to-1 ABCD price projection here. And again, the bearish symmetry concept, so it needs to close above or watch for 92.40. And the price actually closed above the 20-day moving average. So from momentum perspective, things are improving a little bit. So need further strength to for the chart to improve a little bit further. But we could have a similar kind of a move as we were looking at the 30-year bond futures. Now we'll just have a brief look at the gold market, because the gold market is really interesting. This is the COMEX gold daily chart. This is not the spot, so the prices you see, you will see a little bit different prices if you are watching against the spot market. So here, what is really interesting is that we were expecting, or we thought there a possibility for the market to retrace as low as the 38.2% retracement, so 22.75. Market came as low as 22.85, so missed it by $10. Now there is a 1-to-1 price projection pattern. If we just take it like this, it actually calls for the market to be as low as 22.35 to 22.20, which is 50% retracement. But it appeared that intraday, this level of 2300, it was, the market just kept on moving around it. So maybe around this level, there were a fair amount of buyers. So every time the market went to around 2300, the buyers would step in. This is why we have seen a candle like this, which looks like some sort of a variation of a doji candle, which means in decisions there was a lot of pull and push between the buyers and the sellers, and then they just agreed on a narrow range, so a very narrow range price action last Friday. The possibility still exists to move at least to the 22.75, but it looks like this market is developing into a fair amount of trading range after having a really nice trending market for quite a while and hitting the levels that we were watching for on the upside. Now the reason for the gold, or the kind of move that we have seen in the gold market over the course of last 2 to 3 months, is because of the buying coming in from the central banks. Now, if that buying slows down, or the pace of that buying slows down, then the other participants they might not be as big as buyers of the metal, and this is why we could see just a trend line, a trading range develop. Another reason is that if the equity markets begin to pick up, so the risk trade is back again, then maybe the demand for the gold market, for the gold, might get subdued for quite some time. That's also a possibility. So here, fairly neutral on gold. In my opinion, it could be either way, and slightly more bearish than bullish on gold, personally speaking, but really watching this very closely, how the market will develop. So we need to see more bullish candles for us to make a decision whether we might have seen some sort of a tradable low, in my opinion. Now we move to the indices. So this is the cash chart of daily S&P 500. Here, what we had been watching for is the market to go to around 50%, and it did that in an ABCD formation. There was a really big move down. It filled all this gap. It could have been just a gap fill move, but then we looked at the volume, and the volume compared to the gap bar was a little higher, which indicated there might be a further follow through, which we did get the next day. But if you look at this day, it was a huge intraday range day, and then the following day we have seen a micro bottom come in because the price rejected lower prices, moved higher than a last Friday because of the data coming in on the jobs and PMI. The market actually opened up with a pretty big gap around here and closed above the 20-day moving average. Now the possibility for another one-to-one price projection ABCD could in fact see this go to 5150, which is a 61.8% retracement. Now, because of the timing model that we had seen at the beginning of the video, I think we've got about the correction could maybe continue into the second half of the month of May, and then we'll have a shorter window in terms of time. So the possibility that we're looking at for three scenarios, and let me actually go down to the hourly chart to be a little bit more clear. We can see that this huge downward trend has begun into more of a trading range now, because it's moved into a channel formation. So what is also possible is if the market begins to move into the second half of May and we are still going through the correction, then the three scenarios that we're looking for was either for the market to basically form so let me put it this way. So this low that we saw on the 19th of April 2024, if we move into the second part of May, in my opinion, and then we have not seen a huge move to the downside, then chances are for this low might have been an orthodox low. And what do we mean by that? That this low might have been a good low. That possibility is there. And then the other possibility is that the market actually moves lower, especially from 61.8% retracement, and we have this another ABCD nearby, so in that range, and it could actually come and fill in this gap, maybe move a little bit lower, challenge these lows, or come into the in this region as well, which is going to be between 61.8% retracement and 78.6% retracement, even challenging these lows, making slightly lower low as well, which will still be an internal low. So we'll have an orthodox low, and then we'll have a internal low, in my opinion. So that possibility is there. And the third possibility is that this whole move is an ABCD. Now, the more the market moves sideways in a channel formation, for example, and more time it is taking, especially moving the second half of May moving towards the end of the May, and the timing that we have seen at the beginning of the video per our timing model analysis, the chances reduce for a bigger move of the ABCD down to 4,800, in my opinion. So this is why it's really important that how much time this market is going to take if it is a corrective move. Because what we have to also take note of is that it's a channel formation. We are seeing higher bottoms, and also we are seeing higher but these are in channel formation. This is the top of the channel, so fair amount of resistance coming around 5150, maybe a little bit higher to 5180, and that could just produce a technical sell-off as well. That possibility is there. So this is what we're watching in terms of the probability. Now I think I'll just give an equal probability to each one of these scenarios. So with 19th of April being an orthodox low, about 33%, the market coming lower, making an internal low, another 33%, and then an ABCD formation where we could actually see the S&P 500 cash moving to 4,800, maybe another 33%. We'll have to wait and see how the market will actually move next week, and when we begin to move into the second half of the month of May. And the key reason is that the timing that we have seen on the Dow Jones cash index chart. Okay, so now let's just move into the S&P 500 E-mini futures. Here the patterns are a little bit clearer because this market is not exactly 24/7 but 24/5 kind of market. So here what we have been watching for is this 5195, which is an ABCD highlighted in purple, and so that's the one-to-one price projection, and then it could have a move ABCD much lower around to 4812 level, and that would be where the 38.2% retracement is on all this entire move higher from October of 2023. Now that possibility is still there, but look, here we have a micro double bottom, so really nice price action, and then the market is moving high into, like, look at the strength of this bar. So this is something that we need to also consider. So really watching for 51.95, what will happen there, and then that will actually give us a lot more further information. And looking at this on the weekly chart, we can see that the price came in on 2 consecutive, in fact 3 consecutive weekly candles. It is closing above the 20-week moving average, so again to take a note of. Then moving on to the NQs. So here we can see the NASDAQ 100 futures. They have done about an 8.5% correction. And also, if we were to just use the symmetry concept of symmetry, so here we go. This is absolute, not percentage figures. Here we go. It has already done that much correction, but in terms of percentage, the biggest percentage was about 13% and a 12.24%. And this one is, in terms of percentage, much smaller, of course, because the index has moved much higher. But in absolute terms, the moves are symmetric, and you can actually see that. Another reason that I believe that, why I changed my probabilities is because the NASDAQ 100 futures has already done an ABCD kind of move, corrective move before. So it might not do that again in this move higher. So that possibility is there. So this is what we are watching. Again, the market closed above the 20-week moving average. That's a positive, fairly positive thing. Now moving on to the daily chart, and on the daily chart, we were watching for this market to reach about 18,000, and then we were looking for this 1-to-1 price projection lower, but the market has already taken that out. So the next one is, in fact, there's 61.8% retracement level. Here we go. So this market will also be reaching for 61.8%. The S&P 500 futures will also be going for 61.8%. So two markets are kind of moving in a rhythm, but again, look, just like the S&P 500, this market last Friday closed above the 20-day moving average, and look at the strength. These two are really strong bars, and it's also a micro double bottom here as well. So this makes me think that this move is pretty strong, and this ABCD might not happen actually with the 19th of April low. Might be a pretty strong low as well. So we'll wait and see how the price action will develop. But again, the market closed above 20-day moving average. This is something which shorter term traders like to see. Moving into the Russell 2000. This is Russell 2000 daily chart. Last Friday, again, nice rally right into the 61.8% retracement and this ABCD. So this market has already done that move, which we have not seen in the S&P 500 futures yet and the NASDAQ 100 futures yet. But the market still closed positive. So we didn't see a massive candle closing in negative. So again, next trading week is really key. And if we just look at this, it looks more like a double bottom formation around here. So as long as this low is held, it's pretty good for these small caps as well. And just did a video about KRE, which is the regional banking index, where a lot of they give a lot of financing to smaller companies, and that chart also seems to be improving. So that's a pretty interesting development. And from the momentum perspective, the price also closed above the 20-period moving average, and the 8-period moving average is catching up. So we might see positive development taking place if the price remains high on the daily chart. Now look at this one. Market so far rejecting lower price, so that's interesting. Right at the 61.8% retracement, we have a possible ABCD which could be much higher, but we'll have to wait and see. Last but not least, let's take a look at the Dow Jones futures. Look, we had a pullback right from the top of this channel, also ABCD formation. We have 3 consecutive weeks where the market has closed positive and just above the 20-period moving average as well. That's going to be 20-week moving average. And here this market is also moving towards 61.8% retracement, slightly different kind of a pattern to Russell 2000 and the other markets, but again, the market rejected lower prices here. So this is what it is. This I have to now move to here because that pattern did not develop. So yeah, if there is gonna be this ABCD formation kind of a correction, then yeah, this is what but we'll have to wait and see. The market move is pretty strong. Look at these 3 consecutive days, they are pretty strong. Last but not least, I just remembered, let's also take a look at the New York Stock Exchange Composite Index. This one is being capped a little bit by the 61.8% retracement, but it looks to be in early stages of a possible ABCD. If it is able to close above the 61.8% retracement. So again, this one also includes the ADRs, which are the foreign stocks, American Deposit receipts traded on the London Stock Exchange. So again, yeah, it's gonna go for the this level, which is 61.8% retracement as well. So a number of things happening, and the move being pretty strong, coming out of this micro double bottoms here. This is why it makes me think that the 19th of April low might have been a pretty good low. So we're just waiting to see whether the correction will complete or not. Just repeating myself from a timing perspective, 24th May to 29th May, that's something which we are watching for. If the market remains upward to sideways to maybe down a little bit, moving into the second half of May, then this means that the market has taken up a lot of time, and if it's just still stuck in a trading range and it's not really moving down quickly, then the ABCD form of correction to the downside might not happen. So again, we'll evaluate things as we go along, and we'll have to just change the probabilities or the percentage we are giving for those kind of scenarios to develop. So again, really interesting times in the markets. I believe last Wednesday, when the FOMC minutes came out, and during the meeting, the questions and answers, that actually changed quite a few things, provided some clarity to the market. And it does appear that from a geopolitical perspective, we might begin to see or hear some positive developments. And yeah, let's take a look at the crude. So this is something which I'm not following on a daily basis. It's something I watch, but I'm not putting it into our analysis. But I think I should begin to do that, because crude is something which also influences the inflation figures. So we really need to take a look at the whole complex, like heating oil, gasoline, RBOB, and then we need to take a look at the crude, the whole complex of it, because crude is crude, and then there are other products which are used in a different way, and those markets, sometimes one market is ahead of the other market and stuff like that. So maybe a special segment I will develop where we begin to just look at the energy markets, which will include the crude oil, or it will also include not just the WTI but the Brent as well, because sometimes you have to look at the spread, and then also look at things like the RBOB. There's something called crack spread as well, the gasoline contracts, heating oil, everything. Maybe once a week I might do that. So here, just wanted to point out to you guys, look at this. There was one time people were calling for $150 per barrel oil, but look where the market is. Look at the high here. It just went right between the 61 and 78.6% retracement, for a double top around here, and then it's just going down now. It broke this trend line. You look at this trend line here, it doesn't look a bullish chart to me. So a fairly bearish looking chart in crude oil. So and also the summer months are approaching. I would have imagined a lot of people would travel and stuff like that, so there's going to be a demand for gasoline, but the crude chart is just saying that if it just keeps on falling like this, and the crude begins to go below $75 a barrel on the WTI, maybe even below this 67, if it takes these low high, then it's actually setting up for a bigger ABCD to the downside, so which could see much lower crude oil prices, which should not be an inflationary scenario, so which would help to put inflation in check. So that's going to be bullish if one of the concerns has been rate increases due to inflation, but if the crude begins to move lower, so maybe that will just eventually over time begin to play into those figures. So just crude is something that we need to watch as well. So thank you very much for watching the video. Do apologize, really long video, but I think we had to cover a lot of things. Thank you if you have stuck with me this long in this video, for watching the video. And if you like the video, give it a thumbs up. And if you like how we look at the markets and do the analysis, then please do subscribe to the channel. Thank you very much. Good luck, good trading, and speak to you guys soon.